Another report card day for U.S. banks.
The banks fell below minimum requirements.
Now, U.S. banks' profits have fallen 36.5% last year.
Could lead to a crisis bigger and more serious than what we saw in 2008.
Are the banks heading for another financial crisis? This is the story of the crash of the Titans. The bank Titans. This is $100. Suppose for a moment that your bank charged you $100 this year in overdraft fees due to insufficient funds in your account. Let us also suppose that 10,000 people had that very same experience. That would be $1 million collected in overdraft fees. This green dot represents that $1 million. This is what $10 million in overdraft fees would look like. This is what $100 million in overdraft fees would look like. And this is what $1 billion in bank overdraft fees would look like. Now multiply that by 30. In 2020, banks the world over collected over $30 billion in overdraft charges from their customers. And the banks do that every year. This $30 billion figure does not include any other bank charges, just insufficient funds, otherwise known as overdraft fees. $30 billion every year. In America, we believe in helping others and offering a hand of kindness and charity to those in difficult circumstances. But instead, during a worldwide pandemic, banks capitalized on their customers' diminishing incomes and low bank account balances by way of insufficient fund charges. In 2020, J.P. Morgan Chase, Wells Fargo, and Bank of America stockpiled over $1 billion each from overdraft fees alone. The public is becoming fed up with banks and the excessive costs of traditional bank accounts. Add to that other bank assessments like monthly service charges, wire transfer fees, international debt card use fees, low balance and late payment fees, bounce check charges, currency exchange rates, credit card interest, and ATM fees. I think you can see why hardworking Americans trying to live the American dream are growing more and more frustrated, while banks continue to steal those dreams little by little and fee by fee. That frustration is pushing millions to look for better ways to bank. Whether they know it or not, big banks are in trouble and a growing rebellion is headed their way. About 1/3 of Americans have less than $1,000 in savings.
Has a balance of -$76.
Another third have no savings at all. Yet these are the very people that pay these exorbitant fees, and as you can imagine, they add up pretty fast. Monthly service fee, $15. Non-home bank ATM visits, $12. Overdraft charges, $35 each. Late credit card payment, $39. Credit card interest, $27. In a scenario like this, you would pay your bank as much as $128 for a single month in banking services. You might be thinking this would be an unusual amount for a single month, and you're probably right. But even if we remove all the fees and charges except the monthly service fee and the credit card interest, we still end up paying the bank $42 a month. That's over $500 a year, which is quite a chunk of money. The question is, how do we fix that? Where can financially abused bank patrons turn for relief? Who or what is coming to save us? The answer to that question is, it's not coming. It's already here. It's called FinTech, which stands for financial technology. New monetary technologies and innovations are quickly becoming a financial tsunami to big banks, a tsunami for which most banks are woefully unprepared. And it will surely revolutionize banking as we know it today. How? Let's look at a similar revolution that we've experienced in recent history. But first, I'd like to remind you to click the subscribe button and hit the notification bell to be notified of our future videos as we provide you with the knowledge and information you need to live your American dream to the fullest. Thank you for being here. Now let's get back to that example of a disruptive revolution we saw happen fairly recently. In 2007, Apple introduced the iPhone.
Every once in a while, a revolutionary product comes along that changes everything. And we are calling it iPhone.
That same year, AT&T officially announced its exit from the payphone market. Verizon did the same 4 years later. The payphone market at its peak in 1999 grossed over $2.5 billion annually. But suddenly, the need for payphones simply evaporated into thin air.
Payphones have been disappearing from the national landscape at the rate of 10% a year.
Phone company giants like Verizon and AT&T lost billions as the payphone market dried up and blew away. The iPhone did not cause the extinction of payphones. The iPhone was just the leading edge of a much bigger tsunami that decimated the payphone industry. That tsunami was the personal mobile phone. That single technological revolution was responsible for the demise of scores of industries like phone books, handheld cameras and film, printed maps, answering machines, pagers, alarm clocks, day planners, household flashlights, domestic long-distance phone charges, and much more. Smartphones displaced all these industries. Why? Because smartphone technology was disruptive. It improved and enhanced the way people met their daily needs. The old products became obsolete. Banking is about to experience the same type of disruptive revolution through a flood of technological advances in the financial arena. FinTech is such a massive threat because it cuts the banks out completely as the middleman, and new technology fills that void. No longer do you need an army of bank personnel housed at thousands of branch locations to process withdrawals and deposits. Nor do you need loan officers to negotiate, write up, approve, and execute bank loans. Instead, technology does all that for you at a much cheaper cost while offering better and more personalized banking services right in the pocket of anyone with a smartphone. Now, with blockchain technology, Bitcoin-style cryptocurrencies, digital wallets, and other fintech services, physical banks will soon become as outdated as the phone booth. But that's not the best part. The real threat to big banks is when you don't deposit your money into their vaults and instead loan the money directly to a borrower and you make the interest instead of the banks. In other words, you become the banker. That's how disruptive this technology can be. It's called peer-to-peer lending or P2P lending, and it's one of the most serious threats to the big bank giants. Why? Because just like Uber or Lyft facilitates a transaction between a driver and a person needing a ride, P2P lending companies can facilitate a financial transaction between a person with money, called an investor, and a person needing a loan. Depending on the P2P company, you can become an investor for as little as $25. While banks are paying only 1/100% or 0.02% interest on savings, P2P companies like Prosper and MyConstant are paying 5.4% interest to as much as 9% interest annually. There are risks, but that's 500 to 900 times what banks will pay you. Banks are simply no longer being competitive. Just as Uber cut out the taxi companies, P2P lending companies cut out the banks. Both industries and the participants are better off for it. Now, for full disclosure, it may not be quite as simple as I lay it out here. Peer-to-peer lending companies have various fees and charges for different types of loans and risks. I'm not a financial advisor, so you'll have to do your own due diligence. The point is, banks now have growing competition, and some banks may soon find that, like Kmart, Sears, and Toys R Us, they've become obsolete. Still, some big banks are fighting back. JP Morgan Chase is spending $11 billion a year on technology and have hired 50,000 developers and technologists. That's more than Facebook and Twitter combined. On the other hand, P2P companies and digital banks are aggressively eroding the megabank's customer base.
more and more consumers will want to cut out banks and credit card companies and lend directly to each other. They've all jumped into the business of Lending Club, an online peer-to-peer lending platform.
Lending Club is a P2P company that recently acquired Radius Bank and now seems to be a bank hybrid, offering high-yield savings accounts, debit card rewards, and even life insurance. They've adjusted their P2P model a bit, but it still offers far more competitive services and rates than regular banks do. While Chime is not a P2P company, it is a digital-only bank that uses FinTech to compete with big banks. This digital bank has no branch offices, and without brick and mortar overhead, they can offer no monthly service fees, no minimum balance fees, no foreign transactions fees, no in-network ATM fees, and no card replacement fees, and no overdraft fees for insufficient funds. Consequently, 4 years after startup, Chime hit 1 million customers in May of 2018. Just 1 year later, Chime quadrupled their customer base, hitting 4 million customers in 2019. They are by far the fastest growing financial services company in the bank account business. Their customers are largely millennials moving out of trillion-dollar banks to embrace digital banking.
Excuse me, who will be taking the check? Excuse me, sir, I'm sorry, but your card has been declined.
There's another very interesting wrinkle in all this that could threaten not only banks, but even challenge the credit card industry. Think what will happen when MasterCard or Visa users discover they can stop paying 15 to 29% interest by paying off their credit cards with a P2P loan for only 8 to 10% interest. I think you're beginning to see how devastating this revolution can be to big banks and how helpful this technology can be to those seeking the American dream of financial security and independence. Instead of warehousing your money in a bank, placing money in a P2P institution earns you many times the interest a bank will pay you. By cutting out the bank as a middleman, there's a much greater potential windfall. A word of caution. Please read the fine print and fee schedules before borrowing or lending with any institution. Prosper, for example, offers loan rates ranging from as low as 5.99% to as high as 35.97%, depending on the risk. Anytime money is involved, you should know the risks. P2P lending and digital banks are no exception, so be careful. The big banks are also in a tough spot because it costs them almost $1,000 to obtain a new customer. Digital banks can do the same for as little as $20. But there's another looming reason why this fintech tsunami may simply wash banks aside. More progressive companies like Apple, Amazon, Uber, Airbnb, Zoom, and others have conditioned consumers like us to demand a very high level of expectation. But our user experience at banks is usually low and impersonal. Digital banks and services are changing all that, and customers are flocking to online-only banks like Chime. Why? Because of the outstanding user experience and exceptional products and services, and absolutely no physical need to go to the bank. But there's a darker reason why big banks should be concerned. They may have once again put themselves at risk of failing just as the technological tsunami begins to crest.
Citibank has announced plans to quit the consumer banking business in 13 markets across Europe and Asia, including Taiwan.
Remember the banking crisis in 2008? Well, in case you forgot, in the mid-2000s, home prices were rapidly climbing, and mortgage brokers and lenders lowered lending standards so low as to allow new home buyers to borrow well beyond their ability to pay back the loans, which practically guaranteed that they would default on those loans in just a few years. Large groups of these subprime mortgages were then repackaged and bundled, then sold as collateralized debt obligations, or CDOs. Big banks then purchased these risky bundles of mortgages. In 2006, home values declined and homeowners began to default on the house payments they could never really afford in the first place. In 2007 to 2008, the bubble burst, and the last buyers of these bad mortgage bundles, big banks, were stuck holding the bag of bad CDOs. This was the cause of bank failures like Washington Mutual, Lehman Brothers, and Bear Stearns. They had all purchased large amounts of this bad debt and subsequently went bankrupt. But 12 of the nation's 13 largest banks were themselves within a week or two of failing until they received huge financial bailouts. These banks were deemed too big to fail, but have they learned their lesson? Consider this. 13 years ago, they were bailed out for doing essentially the same thing they're doing now. Then it was bad risk mortgage debt bundled into CDOs. This time, it's bad risk business loans bundled as CLOs, or collateralized loan obligations. In short, big banks are setting themselves up to fail once again. When you add up big banks' questionable investments, high customer expectations but poor user service, their outdated products and delivery systems, high-priced customer acquisition costs, non-competitive savings account interest rates, high charges and outdated fee structures, high credit card interest, the public's growing distrust of banks, high brick-and-mortar maintenance costs, and huge staff overhead, you quickly realize that a coming crash of the bank titans is a real and likely future for banks if they don't make major changes very soon. We as a nation, as a world in fact, have come to expect more from all industries and institutions. Big banks are just not hitting that mark. They are failing to meet our needs and our ever-growing expectations. Consequently, they're ripe for disruptive technologies such as FinTech and DeFi to capture much of their market share. The bankers of the future will be very different from the bankers we know today in their attitudes, personalities, and the services they offer. A final point that should be noted. Big banks are also being challenged by big tech, offering financial services through Amazon Pay, PayPal, Apple Pay, Google Pay, WhatsApp, and even Facebook Messenger. These big tech companies are serious competitors, and they do have the financial resources to put serious pressure on banks. Remember, Apple is a $2 trillion company, and Amazon is worth over $1 trillion. But the smaller startup companies are also quickly nibbling away at big banks' low-hanging fruit. And so, the decentralization of banking, finance, investments, and currency is rushing forward, putting you in the driver's seat, or quite possibly even in the banker's seat. FinTech and DeFi have the ability to disrupt and revolutionize banking and other industries, and it's coming soon to a bank near you. The crash of the bank titans is just beginning. Thank you for watching. Next time we'll talk about the American dream of becoming debt-free. There's a deep satisfaction and inner joy of not owing money to anyone. I want you to enjoy that part of living the American dream. I hope you stay tuned. To be notified when that next video is ready, click the subscribe button and then hit the notification bell. Thanks again for watching. I'm Chuck Gray and I'm living the American dream.